Welcome to our general revision in money and capital markets. So here we're going to look at several questions and answers. So we can start. Share. All right, so firstly, we have a recap of our general questions and answers. Section A, we're going to look at short words with answers. Firstly, what is money market? Money market is simply um, a market for short-term funds and securities within a year. And any two examples of money market instruments. The money market instruments, we can even mention four. We have treasury bills, commercial papers, what else? Negotiable certificates, bankers' acceptances, what else? Repos. What is the capital market? This is a market for long-term securities. Okay. Define liquidity. Liquidity is simply the ability to quickly convert our assets into cash without any significant loss. That is what we call liquidity. What's the difference between systematic and unsystematic risk? So systematic risk will affect the whole market, and systematic risk is tailored to a particular firm. Okay, what's the relationship? What is a yield curve? What does it show? It shows the relationship between yields and their maturities. So what are some of the features of a treasury bill? It is issued at a discount. It is also redeemed at par value. What do we call securitization? So this is the aspect of pulling illiquid assets into tradable securities. Okay, so what is a derivative? A derivative in money market is simply a financial contract whose value derives from the underlying asset. That's what we call a derivative. So these terms have been used time and again. So we get to understand these key terminologies. So far, are we together? I hope they are helpful. Or we rush into the calculations. Are we following?
We can,
All right.
yes, we can go into the calculations.
So, so derivative based on, by the term derived, okay, this is a financial contract whose value is derived from the performance of the underlying asset. So upon the underlying assets may include the stocks, bonds, or even commodities. They may also include currencies or market indices. So examples of derivatives we know are futures, options, forward swaps. These are used for hedging risks. State any three forms of EMH. TMH talks about the efficient market hypothesis. So this one suggests that assets prices will reflect all available information, and it has three forms. We have the weak form. Here, prices reflect all past trading information like historical prices, volumes, meaning technical analysis cannot be consistent in here. In the semi-strong form, here prices are incorporated in all publicly available information. In the strong form, here prices reflect all information, both public and private. Okay, so what is a repo? What is a repo agreement? A repo agreement is a repurchase agreement, is a short-term borrowing arrangement where one party sells securities, often government bonds, to another in agreement to buy them back at a specific what? Date and price. So it acts like a collateralized loan. So with securities, serving as a security for borrowing funds. So a repo is commonly used by financial institutions to manage what? Short-term liquidity needs. Okay. What is the role of fintech? We talked about fintech like mobile money. So the main is to expand what? Financial inclusion. This is perhaps a good topic for those of you who would want to do one. So the key role of fintech is to expand financial inclusion. How? Through innovations like mobile money platforms, peer-to-peer lending, online banking, And fintech actually enables individuals and businesses, especially those in unserved remote areas, the rural areas, to access financial services and payments. We are able to do so um, in the rural areas to send money to our grandmas because of that innovation. Right. So we continue here. We What does bond duration measure? What does bond duration measure? So bond duration basically measures what? It measures the duration or sensitivity of a bond to price changes in interest. This one is usually expressed in years. Specifically, it measures the percentage change in a bond's price for a 1% change in interest. So if there's higher duration, it means the bond is more sensitive to any interest or movements. So this duration is what also reflects the weighted average time that an investor will receive the bond's cash flows. What is the central role of Central Securities Depository, CSD? So the CSD is an institution that will provide safekeeping of securities like shares and bonds in electronic or dematerialized form. So its the main role is mainly to facilitate efficient and secure transfer and settlement of security transactions. So it helps to reduce risks associated with what? With physical certificates and to also improve liquidity and transparency. Define balance of payments. What is BOP? Balance of payment is actually a systematic record of all transactions made between our country, Zambia, and the rest of the world. It looks or includes a current account, which are the trade in the goods and services, remittances, and income, and also capital account, like the transfers of capital, and the financial account, which include loans and investments. So any surplus will indicate that there's more inflow than outflow. And we have a deficit, it's just the opposite. Right, give one measure prudential measure taken by Bank of Zambia during COVID-19. So one measure that was taken was a reduction of the reserve ratio for commercial banks. So the reserve ratio is simply the minimum balance that commercial banks must have. So by lowering those statutory reserve ratios, the commercial bank freed up liquidity in the banking system. So it enabled banks to extend credits to you and me. Okay, number 17, why are commercial papers usually unsecured? So these ones are unsecured because they rely on what? The credit worthiness or reputation of the issuing company rather than collateral. Only large and financially strong corporations with high credit ratings can issue them successfully. So this will reduce transaction costs and also allow companies to raise short-term funds quickly. Okay, define what credit rating is. What is credit rating? Credit rating is an independent assessment. Here we have CRB, which is used to measure the credit worthiness or the ability of a borrower. Can be an individual, can be a corporation, can be government to meet what? Their debt obligations. So these ratings are issued by agencies. We have S&P, Moody's. They help to evaluate risk. So if you have a higher rating, you have AAA, indicates um, low ability to default. If you have a low rating, it can give you a B or below. It indicates that you are at risk of borrowing from such an individual country. What does inverted yield curve indicate? So this one looks at the possible economic recession. The inverted yield curve occurs when the long-term interest rates fall below short-term interest rates. So this is an unusual situation, but signals a possible economic recession. So it reflects the investor's expectation of slower growth or lower inflation. So this is what we call the inverted yield. So all these questions are coming from past papers. I've just compiled them so that it's easy for you to go through. Okay. So those are the pamphlets as you go through that will help you. So that is what the inverted yield curve it signals a possible economic recession. Number 20, state one function of the global financial market. Okay, this question doesn't miss. It carries 20 marks. So one key, we talked about several keys. One key of the global financial market is efficient allocation of what? Capital across economies. So they channel funds from surplus um, units, the savers and investors, to the deficit units, the borrowers, companies, and governments. So the global financial markets will ensure that these resources are directed towards the most productive areas. In addition, they'll promote liquidity, price recovery, risk diversification across. These are the other three. Because we made a formula for this for, remember, for PRT. The PPPP is the pools funds, okay, price recovery, okay, promote liquidity, risk diversification. Are we together? Okay.
Yes, sir.
So we go to section B. I put section B. These are short word answers that would be um, um, at least discussed. Theoretical questions are important, but sometimes when you calculate too much, you may end up missing even easier things. So, what are the functions of the global financial system? Uh, Mobilization of savings. So, it collects funds from households, businesses, and governments worldwide and channels them to productive investment. Okay. Secondly, allocation of capital to ensure that capital will flow to the most efficient and profitable areas. Risk management. The system will enable investors to spread what investments across different countries. Provision of liquidity, it will provide mechanisms for investors to buy or sell securities quickly without any major price disruptions. It also facilitates payment and settlement. So international payment systems will allow for smooth transfer of these funds across borders. The types of money market instruments. We have treasury bills, commercial papers, bankers' acceptances, negotiable certificates, and repos. Treasury bills are short-term debt instruments, usually 91, 182, and 364. They are sold at a discount and redeemed at full face value. Then commercial papers, usually they are unsecured short-term promissory notes that are issued by corporations with strong credit ratings. Bankers' acceptances, these are time drafts that are guaranteed by banks. They are often used in international trade. Exporters and importers will rely on PAs to secure transactions. Negotiable certificates here, bank issued time deposits can be traded in the secondary market so they can pay a fixed interest that is negotiable before maturity. Repurchase agreements is a short-term collateralized borrowing arrangement where securities, often government bonds, are sold with an agreement to repurchase them at a future date. What are some of the forces that have initiated um, globalization of finance? So I talked about this yesterday, that long ago, the um, finance or government was closed. Now, with this increasing interconnectedness of the world, financial markets have been made, and these are several reasons. Number one, technology. So advances in technology like fintech, electronic trading platforms, they have reduced what? Transaction costs. Deregularization. So many countries have liberalized their financial markets. So this has reduced the restrictions on capital flows and foreign direct investment. Financial innovation, development of new instruments like derivatives, securitized assets. So these ones have facilitated what? Risk management and growth in multinational companies. Okay, growth in multinational companies. Are we together? Any additions on that? Are we following?
Yes, we are together.
Okay, so also the other factors include global trade expansion. So increased international trade flows will create demand for cross-border payments, financing, also hedging, and stock market integration. So global investors can now access equity markets in multiple countries. So This will lead to greater cross listings and integration of stock exchanges, right? Then we go to our next question. What capital markets in Zambia? Okay, capital market securities in Zambia. What are the most common capital market securities in Zambia that we use? So the capital markets deal with long-term securities whose maturities are over a year. So they're used to finance what investments and development projects in Zambia. So these could be government bonds. They are issued by government to finance the fiscal deficits and infrastructure. So these ones are considered low risk. We also have corporate bonds. These are debt instruments that are issued by the private companies to raise long-term funds, investors who earn an interest which we call coupon payment. Equities also, these are shares that are traded on the stock market. Municipal bonds, these are issued by the local authorities to fund projects like roads. Okay. Then financial derivatives that are in Zambia. So derivatives in Zambia are also developing increasingly. They are used by banks, corporations, and investors to hedge against risks. So some of the financial derivatives that we should know are swaps. What are currency swaps? These are simply agreements between parties to exchange principal and interest rates in different currencies. These are usually used to hedge against foreign exchange risk. Forward contracts usually, these are customized agreements that entered into to buy or sell an asset using a foreign currency at a predetermined price and future date. So they are widely used in export and import businesses. Futures contract, these are standardized contracts that are traded on organized exchanges to buy or sell assets at a set price and date. So in Zambia, this adoption still remains limited compared to other countries. What are options? Options are contracts that will grant the buyer the right, not the obligation, just the right to buy or sell an asset at a predetermined price within a specified period. They are useful in managing what? Commodity and currency risks. All right. So these are derivatives that are found in Zambia. So we go to our treasury bill calculations. So we have a treasury bill with a face value of 10 million. It's a 90-day with a yield of what? 5.2 and 3 months. Find the issue price. So the price here is equal to the face value 1 minus dt over 360. Okay. 1 minus dt over 360. So I say this formula can be the easiest. Others can say issue price is simply what? Face value 1 minus what? Y times time over 36. It's the same thing, just mathematical arrangement. So the face value is 10 million. The maturity, of course, treasury bills are 91,182, but just for what has been given, so 90, and the yield is 5.25. So we can put it in there. So we're going to substitute here. We're going to have 10 minus 1 minus the yield. Our yield is what? 5%, 0.02, 0.025. Okay. And its time is 90 over 360. Then you get 9,800. So we've been doing this question over and over. And it's been appearing oftentimes there in your exam. Okay. So this is the same question except that we're using a commercial paper. So if you notice, all these papers are calculated the same. Face value 1 minus dt over 360. So Kalusha Cement has a 180-day commercial paper whose face value is what? 65 million. And discount rate is what? 15. So the issue price is simply, you want, you can say future value or face value 1 minus, okay, d times time over 360. Notice that's the same thing. So, just use this here. F is 1 minus d t over 360. So our d is our discount rate, not the yield this time, discount rate. So this one comes here, this one comes here, and our time is 182. This one comes here. Okay, the rest is just an issue of computation. So from 65, you get 62 million. Are we following? Then after getting the 62, the money market yield now, it's a tricky one. You substitute this one here. It's like face value minus issue price over issue price and 360 over time. So this is the price that comes here. Okay, it's based on that one. The face value is what we started with, 65 minus 62 over 62 times 360 over the time, which is 162. So this is how we find our money market yield. Are we together? Are we following?
Yes, we are.
Okay. So now it's becoming easier to understand because we've been going through these questions over and over. Coupon bond, a zero coupon bond, okay, with a face value of 100,000, it's a 5-year and the required rate of return. So if it's a zero coupon bond, the price of the bond is simply the face value 1 plus r at the power t. So 1.2 to the power 5. So this is 40. We did this in the afternoon. Okay. A repo, an investor buys securities at 9.8 and resells at 10,000 after 60 days. Calculate the yield of the repo. The yield of the repo is equal to what? Selling price minus buying price over buying price, 360 over time. So it's selling price is what? 10,000. Buying price is 9.8. The number of days is 60 days. So 10 minus 9.8 over 9.8 times 360 over 60. So here we're going to get 9%. Okay. Bond valuation. So bond valuation, if you have the face value of 1,000, coupon interest is 10%, and the yield to maturity is 12%, and time is 4 years. So your textbook uses this formula to calculate the value of the bond. Those who are comfortable with this, you can use this formula. But I have taught you a shortcut formula. Value of the bond is equal to what? I'm just getting these questions as they are in the textbook. So some of the solutions are exactly the way they are done in the textbook. So it's simply coupon value, present value annuity, then plus S value, then interest factor, present value interest factor. Okay. So the coupon interest, 10% of 1,000 would be 100. So these are the 100. How many years? 4 years. So 100, 1.1 to the power 1. 100, 1.1 to the power 2. 100, 1.1 to the power 100, 1.1 to the power 4 years. Then in the last year, they'll give you back your money, which is the 1,000 or 1.1 to the power 4. So you still get the same answer, which is 939. If you don't want to memorize this formula, this is easier. Okay. Treasury bill. So treasury bill of 10,000 whose maturity is 90 days at 5.25. I get the issue price. So here the 10,000, we put it here. Okay. The yield is 5% and our time in years is 90. So we calculate that, we get 9.8. Okay. So we've done this question already. Okay. Are we together? Any questions? So I would want now us to go. Basically, we finished all the questions that have ever come in your exams. They're there in my videos. So uh, basically, we're doing all the questions over and over. So now the case studies, but everything has been covered, even the short word answer questions. Right, so we have a case study there. Kim, you had asked about the case studies. So the case study emphasizes the difficulties placed on investors, advisors because the global financial market crisis that occurred in 2008. The crisis was because of the crumbling mortgage market and the impact of the collateralized debt obligations associated with the industry. Rudy, a prominent respected investment advisor, is concerned with advising his clients who are worried about losing their investment and savings due to the crisis. The Dow Jones Industry Average was on a downward trend, and together with the Toronto Exchange Rate at the lowest level since 2003, Rome must have considered his obligations to the client, his professional abilities are legal, and ensure the best protection possible for securing his clients' portfolios efficiently in the face of a very challenging economic environment. With this short excerpt in consideration, discuss any five functions of the global financial system as it pertains to the money and capital markets. So, basically look at the functions of the global financial market. So, what are they? We just talked about them. 4 P's. Number one, in pooling resources and subdivision of ownership. So, the function primarily of the capital markets is to allow bringing together the capital from large number of scattered investors to finance a large-scale project, right? So in our case study, this function is precisely what went wrong. So the financial inclusions pulled millions of individuals' mortgages, including the high risk, and subdivided them into complex securities and collateralized debt obligations, CDOs. So these CDOs were sold to investors worldwide, including potentially Rudo wrongs clients. So this crisis occurred because the risk pulled the assets profoundly. They were mispriced or misunderstood. So one of the functions is pulling resources and subdividing them. Secondly, it's price discovery for financial assets. So the function of financial markets to provide a mechanism for determining the prices of these financial assets, like the stocks and bonds, through the continuation of the interaction between the buyers and the sellers. And this process incorporates all available information into an asset's price and will reflect the perceived risk that could be there. So in connection to the case, you can simply say this study mentioned Dow and Jones in Toronto hitting the multi-year lows. So this price discovery function is a state of an extreme shock. So the market was rapidly discovering what was previously accepted. Okay. Another one is of risk transfer and management. So financial markets are there to do what? To allow for the transfer of risk from those ones who are risk averse to those ones who are willing to bear it for a price. So instruments like derivatives, which are options and swaps, and diversification, these are key tools for mitigating this risk. So in connection to this case, we could simply say that this function failed while risk was transferred from the mortgage lenders to the investors using the CDOs, and then to the issuers via the credit default swaps. So it was not managed. So the system centralized risk rather than dispersing it. The other function is that liquidity provision. So financial markets are there, or global markets are there to provide the ability to buy or sell your asset quickly without causing significant change in price. So the money market and capital markets provided what? Liquidity that will offer a ready market for investors to convert their investments into cash. So this is what encourages investment and ensures that investors are not locked in. So in connection to this case, liquidity was evaporated. So the markets for the CDOs and other complex securities became frozen. So no one saw their value and no one was willing to buy them. So this was a core element in the challenging economic environment. So it was even mentioned that if wrong, their clients did not want to sell them, the disappearance of the liquidity meant that the portfolio value was purely what? Notional or impossible to realize. Then lastly, but not the least, the other function of financial market is a mechanism for payment and settlement. So they will provide a pathway to provide protocols for safe and efficient settlement of transactions. So this includes everything starting from clearing trades, from exchange to processing to electronic transfers, so EFTs, and also smooth operation. So in connection to this case, we could simply say that the crisis threatened the core operation function. So the failure of major institutions like the Urban Brothers, it raised fears in this risk. So the risk that institutions on the other side of the trade couldn't be able to honor the obligation. So in a nutshell, we can simply say that the 2008 financial crisis was not a failure of these concepts that we agree upon. So the case study was a failure. So the failure is in execution and regulation. So the system was designed to pool resources, was designed to discover prices, was designed to manage risk, but it became overly complex. It was opaque, it was interconnected. So as a result, Rudy Rong's role as an investment advisor became so difficult. So it shifted wealth creation to wealth preservation and navigating of the financial system, whose core functions were impaired. So this is how the 25-mark question could be answered, right? So those ones that got the pamphlet, the other two are complementary, both pamphlet and one is too big. So remind me to give you the other copies that have the solutions to this. All right. So the Bank of Zambia stands steady to support necessary uh, forestall impairment of the financial system during the COVID-19 era. Dr. Chipimo, Deputy Governor, Operations, in view of this statement, discussed the impact of any five prudential measures of the Bank of Zambia as introduced in supporting the financial sector in this period of stress. So you need to provide any potential measures that Zambia, and these ones were there in our multiple choice questions. Who would want to try on that? Okay, so we end here, so you can go through the others later.